Welcome to the deep dive. We've got the DCM Shriram results here for Q2 and first half of FY26 ending September 30th. Lots to unpack.
Absolutely. The press release certainly painted a rosy picture.
It did, yeah. Headlines like robust performance, strong growth in chemicals, profitability way up. So our job today really is to get behind those big percentages for you. We need to figure out what's really driving this surge. Is it core operations or, well, something else? Separate the sustainable stuff from maybe more temporary boosts.
And that's crucial because the top-line numbers themselves are pretty dramatic. Looking at the consolidated figures for Q2 revenue from operations, it was solid, up 10% year over year.
Okay, 10%. So 3,432 crore, decent growth.
Decent, yes. But the profitability, that's where it gets interesting and, well, demands this closer look.
Right. That PBDIT profit before depreciation, interest, and tax hit 408 crore. That's a jump of what, 74% year over year?
74%. It's a massive leap. And then if you go further down the bottom line, net profit after tax, or PT, that surged an incredible 152%.
Wow, 152% to 159 crore.
Exactly. When you see triple-digit PP growth like that in one quarter for a big diversified company, well, you know there's more to the story.
For sure. And they declared a pretty hefty interim dividend, too.
They did. Signaling confidence, I suppose,
Yeah.
180%, which works out to 3.60 per share.
Okay, 152% PP growth. We need to understand that. So let's unpack it. Where did that huge consolidated PBDIT jump actually come from? Which segment did the heavy lifting? The sources seem to point straight at chemicals.
Oh, absolutely. Chemicals was the standout performer this quarter, no question. Segment revenue was up 50% year over year.
50%. Okay, so 913 crore.
Right. But look at the profit metric for the segment, the PBDIT. That surged. Wait for it, 195%.
195%. Okay, that's where a consolidated 74% spike is really coming from. So let's get under the hood there. Operationally, what drove that in chlor-alkali? Mostly caustic soda.
Well, operationally, things were definitely strong. They benefited directly from capacity expansions they'd finished earlier. Caustic volumes were up 22% this quarter.
22% higher volume, okay.
Yeah, and that pushed their capacity utilization up significantly. It was 81% in Q2, compared to just 70% in the same quarter last year. Better utilization obviously helps absorb fixed costs.
Makes sense.
And they also reported improved ECU margins. ECU, that's electrochemical unit, the standard margin measure for chlor-alkali. Those were up a respectable 9%.
Okay, solid operational improvements, higher volume, better utilization, 9% better margins. But hang on, that doesn't get you anywhere near 195% profit growth, does it?
No, it doesn't. Not even close. And this is the twist, the really crucial part for you listening to understand.
Right. There's something else going on here.
Exactly. That huge percentage jump isn't just from selling more caustic soda slightly more profitably. We have to talk about a significant non-operational factor, government incentive income.
Ah, okay. How much are we talking about?
We're talking 76 crore, recognized in Q2 FY26 under the Gujarat Industrial Policy 2015.
76 crore. And how does that compare to last year?
Well, that's the key. In Q2 of FY25, the same period last year, they only recognized euro 20 crore of this incentive income.
So the difference is 56 crore, just in that one line item year over year.
Precisely. That 56 crore difference in recognized non-operational income is the main lever, mechanically speaking, behind that dramatic 195% PBDIT growth figure.
That context changes everything. You see 195% and think operations are on fire, but it's much more nuanced. If we try to sort of normalize for that accounting difference, what does the underlying operational PBDIT growth actually look like? Rough numbers.
It's definitely much, much lower than 195%. I mean, let's see, segment PBDIT was 254 crore. Take away the 76 crore incentive. You're looking at an underlying operating profit closer to maybe 178 crore.
Okay, 178.
Which is still very good growth over last year's underlying number, don't get me wrong. But it frames it correctly for you, right? The strength is there, volume, utilization, but that headline hyper-growth percentage, that's largely down to the timing of these incentive recognitions.
That's the core takeaway. Absolutely crucial. Okay, shifting gears slightly within chemicals. What about the vinyls subsegment? PVC, carbide. Was that as straightforward?
Not quite, no. Vinyl volumes were actually up strongly 29% in Q2, so operationally they delivered.
Good volume growth.
Yeah, but they ran headfirst into some pretty tough global pricing. PVC prices specifically were down about 12.5% year over year.
Ouch. So that hit margins.
It did. despite them maintaining, better operating efficiencies, that price pressure really squeezed margins.
Is there any relief in sight there?
Well, the sources mentioned some potential good news. The Director General of Trade Remedies recently released final findings on PVC anti-dumping duties. The company seems pretty optimistic that the final notification will come through soon.
And that would help domestic prices.
It should, yes. Bring some much-needed support to domestic prices and hopefully margins in the next few quarters.
Okay. So the chemical story is strong operations, somewhat flattered by incentive timing, but also they're making strategic moves, aren't they? Not just running the current assets harder, but pushing into new areas.
Absolutely. That's the other big part of the chemical story. It's shifting from just a commodity play towards strategic integration and higher value stuff. They made two really key moves in Q2 that show this push into advanced materials.
Oh, really? What were they?
First, they completed the 100% acquisition of Hindustan Specialty Chemicals Limited HSCL.
HSCL, right. What does that bring them?
That gives them an immediate direct foothold in advanced materials,
Yeah.
specifically epoxy and its derivatives.
Interesting. And the second move?
The second one connects directly back to their core chlor-alkali business. They commissioned the first phase of their epichlorohydrin plant, ECH, at Bharuch.
ECH, epichlorohydrin. Okay.
Yeah, it's a key intermediate chemical used heavily to make epoxy resins. So they brought 35,000 tons per year TPA capacity online.
35,000 TPA.
And there's another 17,000 TPA expected shortly. This is basically forward integration, right? Taking their base caustic soda output and upgrading it into higher margin specialty products.
That move into advanced specialty chemicals, is that a much trickier business than their traditional commodities? Higher risk, maybe? Steeper learning curve?
Oh, definitely steeper. Yeah, commodity chemicals are all about volume and cost. Specialty chemicals, that needs much more R&D focus, really tight quality control, sophisticated marketing.
So how are they managing that leap?
Well, buying HSCL helps a lot. It gives them immediate expertise and existing customer base, helps shortcut some of that learning curve. And building the ECH plant shows they're serious about creating this integrated value chain for epoxy, reducing reliance on outside suppliers for the king ingredients.
Makes sense. And it's not just forward integration into specialties, is it? They're also looking backwards, securing raw materials.
That's right. Very much focused on cost control, too. They announced a plan to buy Saltworks, about 175 crore investment.
Saltworks? Why salt?
Salt is a fundamental raw material for making caustic soda, a huge input. So this acquisition gives them about 2.1 lakh tons per year capacity. It's classic backward integration.
Securing their own supply.
Exactly. Think of it like securing the pantry for the kitchen. It locks down roughly 13% of their total salt needs. That helps consolidate their cost position and guarantees supply, which is vital when you're running high-volume chemical plants.
That's a really comprehensive approach, managing costs, integrating forward and backward. Very impressive. Okay, chemicals was clearly the main engine this quarter, but it is a diversified company. Let's quickly check in on the other segments. Agri and building systems. Were they pulling their weight? How did Shriram Farm Solutions do?
The agri-business, SFS, actually had a pretty strong quarter too. Robust, volume-driven growth. Q2 revenue was up 27%.
27%, okay.
Yeah.
To 471 crore and profits.
PBDIT was up even more, 47%, hitting 106 crore. The growth came mainly from higher volumes in their research wheat and crop protection verticals.
And I noticed something about R&D there. They seem to be investing in their own pipeline.
Yes, they are, which is a good sign, right?
Yeah.
Their success isn't just about market conditions. They launched 11 new products in the first half of the year alone.
11 new products, wow.
Yeah, and importantly, 4 of those came directly out of their own R&D efforts. That shows real strength in a business like seeds and crop protection, where you constantly need innovation.
Definitely. Okay, next up, Fenesta Building Systems. Windows, doors, that sort of thing. Revenue up 28% in Q2 strong. But the pipeline, the order book looked exceptional.
Yeah, Fenesta's revenue hit 283 crore, good growth. But you're right, the forward-looking number is the real eye-catcher. Their order book was up, get this, 71% year-over-year in Q2.
71%. That's huge visibility, suggesting strong revenues for quite a while. What's driving that? Just the strong real estate market.
That's definitely a big part of it. The underlying real estate cycle in India, especially for higher-end homes and projects, is very strong right now, and Fenesta plays right into that.
A 71% jump in orders, though. Can their supply chain actually handle that kind of volume increase without margins taking a hit?
That's a fair question. The sources suggest they're thinking about that, and we'll see it reflected in their CapEx plans shortly. But they're also actively broadening their offerings, moving into aluminum systems, facades, hardware solutions, not just UPVC anymore.
Diversifying the product range.
Exactly. And expanding their geographic reach like crazy. There are 975 cities across India now, plus a presence in 4 other countries. Management is clearly riding that premiumization wave in housing.
Okay, makes sense. Now let's tackle the trickiest segment, sugar and ethanol. Top line actually shrank 6% year over year. Why was that?
Simple reason, really. Lower sales volumes. They sold 9% less domestic sugar, and ethanol volumes were also down by 13%.
Okay, lower volumes. But then the Q2 PBDIT for sugar surged 143%. We've seen this pattern before today. What's the story here? Why the big disconnect?
It's another case, of a non-operational item boosting the reported profit number significantly. The PBDIT jump was partly due to better ethanol margins, which is good, operational improvement.
Yeah, better margins help.
But a big chunk came from a positive impact of 15.5 crore. This was recognized because of an upward revision in power tariffs by UPPCL, the Uttar Pradesh Power Corporation.
So another one-off boost. We need to mentally back out about 15.5 crore again to gauge the real operating health of the sugar division.
Precisely. And looking ahead, management sounds quite cautious about this segment. They pointed to specific pressures from policy and costs.
Like what?
Well, they expect about 3 million metric tons to be added to the closing sugar stock this season, which, in their view, underlines why the government really needs to allow sugar exports just to balance things out.
Manage the inventory buildup.
Right. And they also mentioned that this issue of a retrospective export fee on ethanol is still tied up in the court's sub judice. So this segment is very exposed to policy shifts and requires careful navigation.
Okay, that gives us a good picture across the board. High growth, but driven by different factors: capacity, incentives in chemicals, solid momentum in agri-business, policy risks in sugar. Let's wrap up by looking forward. How do these strategic moves translate into future spending CapEx and their whole sustainability plan?
Well, the amount they've already spent on CapEx in the last couple of years shows they're serious about the long term. They're not just banking good quarters. They're investing heavily to lock in future growth and efficiency.
Can you list maybe 3 or 4 key projects they've already completed, just to give a sense of the scale and direction?
Sure. Key ones recently finished include that big 850 TPD caustic soda expansion at Bharuch, along with a 120 millido power plant there that directly feeds into the chemical volume growth we talked about.
Right, enabling that growth.
They also finished a 52,500 TPA hydrogen peroxide plant. And significantly, they commissioned a 12 TPD compressed biogas plant, CBG, at Ajbapur.
CBG, compressed biogas. That's an interesting move into green energy.
It is, marks their entry there.
So what's currently under implementation? What's the pipeline look like through, say, FY27?
The pipeline seems tightly focused on, integration and green energy, which kind of reinforce each other. For Fenesta, remember that huge order book?
A 71% jump?
Right. To support that, they're building an aluminum extrusion plant in Kota. That's critical. Gives them captive supply for their growing aluminum window and facade business. Helps manage that supply chain risk you asked about earlier.
Vertical integration for Fenesta. Okay.
Then on the sustainability front, they're putting in a 68 milliW captive renewable energy project, also in Kota, partnering with JSW Renewables on that.
Why captive renewables cost?
Cost is a huge factor, yes. Captive renewable power is almost always cheaper in the long run than grid power, especially for energy-hungry processes like making chemicals. And it's cleaner, obviously. Improves their long-term cost structure and their green credentials.
Makes sense. Any more integration happening on the chemical side, leveraging that core chlorine output?
Yep, more downstream integration. They're building a 100 TPD aluminum chloride plant and a 225 TPD calcium chloride plant.
Okay, what's the logic there?
It's about maximizing value from their core process. Making caustic soda also produces chlorine as a byproduct. These plants take that chlorine, which might otherwise be waste or a low-value product, and turn it into more valuable, specialized industrial chemicals.
Smart. Getting more value out of every part of the process. And all this focus on efficiency and renewables ties into their sustainability goals, right? Which seem quite ambitious already.
They are ambitious. The company already gets 35% of its energy from green sources, which is pretty high. And they have this impressive 10x water conservation ratio.
10 times water positive.
Yeah. So this pipeline of new investments, it just underlines that strategy. Focusing on technology-driven, lower-carbon businesses, making sure growth is profitable, but also future-proofed against environmental regulations and expectations.
Okay, let's try and synthesize this for everyone listening. The headline story, that impressive profit spike in Q2, was really driven mostly by chemicals. That was backed by strong volume growth from earlier investments, but critically also boosted significantly by that large one-time government incentive payment. That really inflated the percentage growth number.
Correct. You have to look past that incentive income to see the underlying operational strength, which is there. And beyond the quarterly numbers, the big picture is this conglomerate actively repositioning itself, moving into integrated advanced specialty materials like epoxy.
Through the HSCL acquisition and the ECH plan.
Exactly. While also leveraging diversification in other high-growth domestic areas like Finesta with that massive order book visibility.
And management seems aware of the global risks, trade issues, geopolitics, but they sound pretty confident about India outperforming, driven by domestic demand. They're clearly using their strong balance sheet to invest across these different opportunities.
Which leads us to maybe a final thought for you to chew on, building on that strategic pivot we discussed. We see this company, traditionally big in commodity chemicals like caustic soda, now making a very deliberate, aggressive move into advanced materials, epoxy, ECH, HSCL.
Right, a clear shift.
So if you connect that shift from volume-driven commodities to higher value, but maybe more complex specialties, what does that really mean for the company's long-term risk profile and its growth path? What specific future result, maybe beyond just another strong PBDIT number next quarter, will truly tell us that these big multi-core investments in specialties have paid off strategically?
Will it be sustained high margins in those new segments? Or maybe a fundamental change in how the market values the company overall?
Something to think about. What's the real proof point down the road?
Indeed. Something for you to mull over until our next deep dive.